What happens to your family's dreams if life suddenly takes an unexpected turn? In the next few minutes, this video will show you why life insurance is not just a product, it's a financial shield. We'll cover what life insurance actually means, types of life insurance, practical examples with numbers, who should buy which plan, benefits, and a quick overview of India's life insurance market, plus, how we can increase awareness and penetration across the country. Let's begin the journey to financial security. Life insurance is a contract where you pay small premiums, and in return, the insurer promises a large payout either on death or at the end of the policy term. Think of it as transferring financial risk from your family to the insurance company. It ensures that your family's lifestyle, any EMI, and future goals don't collapse even if life throws an unexpected shock. We juggle responsibilities like income, family, education, and loans. But life risks are unpredictable. Life insurance helps you prioritize protection before anything else. Now, let's break down the different life insurance plans available in India based on standard classifications. Type 1. Term insurance. It is the purest and cheapest form of protection. You pay a small premium, and your family gets a large sum assured if you are no longer around. Let's understand how age affects your term insurance premium with a simple example. If a 25-year-old buys a 1 crore term insurance plan, the yearly premium is approximately 8,000 rupees to 10,000 rupees. But for the same 1 crore cover, a 40-year-old pays almost double, around 18,000 rupees to Rs 22,000 per year. Why does this happen? Because age is directly linked to risk. The older you are, the higher the chances of health issues, and therefore the higher the premium. That's why buying early locks your premium at a low rate for the entire policy term. So, who should buy term insurance? Anyone between 22 to 45 years. Anyone with a salary or regular income. Anyone with loans, dependents. Anyone whose family relies on their income for day-to-day life. If your income supports your parents, spouse, children, or future goals, then term insurance becomes a non-negotiable part of your financial planning. The biggest benefit of term insurance is simple: you get high coverage at a very low cost. You can secure your family's future with a 1 crore cover for the price of a dinner outing. It also provides tax benefits under Section 80C, reducing your taxable income every year. But the most important benefit is peace of mind. If something happens to you, your family gets an immediate, tax-free payout that replaces your income and protects their lifestyle. That's why term insurance is essential for every earning member. Type 2. Whole life insurance. Whole life insurance is a type of permanent life insurance that provides lifelong coverage and includes a cash value component that grows over time. The cash value component is the accumulated savings built into certain permanent life insurance policies, like whole life insurance. A portion of the premium payments goes toward this savings component, which grows tax-deferred over time. Policyholders can access this cash value during their lifetime through loans, partial withdrawals, or by using it to pay premiums, and can also receive it by surrendering the policy. It guarantees a death benefit to the policy's beneficiaries as long as premiums are paid, and the cash value can be borrowed against or withdrawn. Premiums are typically fixed for the life of the policy, making it a tool for both long-term financial protection and a savings or investment vehicle. Now let's understand whole life insurance with a simple example. Suppose you pay a premium of Rs 25,000 per year. In return, the insurance company guarantees a payout of 15 to 20 lakhs, and here's the important part: this amount is paid whenever death occurs, whether that is at age 60, 80, or even 100. This is why whole life insurance is often called a lifetime financial gift to your family. So, who should consider buying a whole life plan? Anyone aged 30 and above. People who want to do estate planning. Parents who want to leave a guaranteed, tax-free legacy for their children. Individuals who want a permanent cover, not limited by a 20 or 30-year term. Whole life insurance ensures that no matter when you pass away, your family receives a meaningful financial benefit. Whole life plans come with some powerful benefits. First, you get lifetime cover. Your policy never expires as long as premiums are paid. Second, many whole life policies offer cash value build-up. This means a portion of your premium slowly grows over time, creating a savings component you can borrow against or use later in life. And finally, the death benefit is guaranteed and tax-free, making it an excellent tool for family security and wealth transfer. Whole life insurance is perfect for those who want to leave behind a permanent financial safety net for their loved ones. Type 3. Endowment Plan. It combines savings with life cover. It pays a lump sum to the policyholder if they survive the policy term, or to their nominee in the event of their death. It's a low-risk investment designed for long-term goals like retirement or a child's education, providing both a safety net and a way to build wealth over time. Let's understand how an endowment plan works with a simple example. Imagine you pay a premium of 40,000 per year for a policy term of 20 years. At the end of the term, you receive a guaranteed maturity amount of approximately 10 to 12 lakh, which includes the sum assured along with bonuses declared by the insurance company. This makes endowment plans a great choice for people who want both life cover and disciplined, low-risk savings in one product. So, who should consider buying an endowment plan? Individuals aged 25 to 45 years. Anyone who wants forced savings, meaning a plan that automatically builds a corpus. People who prefer guaranteed returns instead of taking market risks. Ideal for young parents and working professionals planning for future milestones. If you're someone who likes financial stability and predictability, an endowment plan fits perfectly. Endowment plans offer several valuable benefits. First, they provide low-risk guaranteed savings, making them suitable for conservative investors. Second, they create a lump sum amount at maturity, which can be used for important life goals, such as your child's education, marriage, buying a home, or building a secure emergency fund. And of course, in case of the policyholder's death, the family receives the sum assured, ensuring financial protection. Endowment plans combine security, savings, and certainty, making them one of the most trusted traditional insurance options. Type 4. Money Back Plan. It is a type of life insurance that provides life cover and periodic payouts of a percentage of the sum assured at regular intervals during the policy term. If the policyholder survives the full term, they receive the remaining sum assured plus any bonuses at maturity. If the policyholder passes away, the nominee receives the full sum assured, regardless of the periodic payouts already received. Let's break down how a money back plan works with a simple example. Imagine a policy with a 20-year term. In this plan, you get 20% payout every 5 years, so you receive money in the 5th year, 10th year, and 15th year. Then, at the end of 20 years, you receive the remaining balance along with bonuses. This structure gives you periodic cash inflows during the policy term while still ensuring a substantial maturity amount at the end. So, who should consider a money-back plan? Individuals aged 25 to 45 years. People who want liquidity at regular intervals. Anyone who needs money for short-term goals, such as school fees, home renovation, vacation planning, or EMI. Perfect for those who prefer safety and financial discipline, but still want access to funds without breaking the policy. Money-back plans come with two major benefits. First, they offer regular payouts, which act like financial milestones at fixed intervals throughout the policy. This makes them ideal for families with recurring expenses. Second, they provide guaranteed returns. The payouts and the final maturity value, including bonuses, are predictable and risk-free, making this plan suitable for people who prefer stability over market-linked investments. Overall, money-back plans are a great blend of protection, savings, and periodic liquidity. Type 5. ULIP. Unit-Linked Life Insurance Policies. It is a financial product that combines life insurance coverage with market-linked investments. A portion of the premium provides life cover, while the remainder is invested in a choice of funds, such as equities, debt, or hybrid funds. This provides a dual benefit of financial protection for your family and the potential for wealth creation over the long term. It typically have a mandatory 5-year lock-in period and offer potential tax benefits. Now let's understand unit-linked insurance plans with a simple example. Suppose you invest 50,000 per year in this plan. Over a period of 10 years, your investment can grow into a corpus of approximately 7 to 8 lakhs, depending on how the market performs. It links your money to equity, debt, or balanced funds, which means the returns are market-driven, giving you the potential to earn higher returns compared to traditional plans. So, who should consider buying a ULIP? Individuals aged 25 to 40 years. People with a higher risk appetite. Long-term wealth creators who want to grow their money over 10 to 15 years. Investors who prefer combining insurance protection with market opportunities. If you want your insurance plan to also help you build wealth, a ULIP is one of the most flexible and growth-oriented options. ULIPs come with some significant benefits. First, they offer market-linked returns, which means your money has the potential to grow faster when markets perform well. Second, ULIPs are tax-efficient, giving you deductions on premiums and in many cases, tax-free maturity benefits under current tax laws. And third, they offer fund switching flexibility. You can move your money between equity, debt, and balanced funds depending on market conditions and your risk preference, all without exiting the policy. With ULIPs, you get protection plus the power of long-term wealth creation in one single product. Type 6. Annuity, pension plans, refers to financial products designed to provide a guaranteed, regular income stream during retirement. They are a crucial component of retirement planning, ensuring individuals have a steady cash flow after their working years. Let's understand how a pension or annuity plan works with a simple example. Imagine you invest a lump sum of 10 lakh rupees into an annuity plan. In return, the insurance company starts paying you a monthly pension of around 7,000 rupees to 9,000 rupees, and this income continues for your entire lifetime. This makes annuity plans one of the safest ways to secure a steady cash flow after retirement. So, who should consider a pension or annuity plan? Individuals aged 40 and above, who want to start planning early for their retirement. People who are near retirement and want guaranteed income. Anyone who wants their savings to convert into a dependable monthly income, instead of withdrawing money randomly from their bank balance. Annuity plans are especially useful for those who prefer stability and predictable income after they stop working. Pension plans offer two important benefits. First, they provide a steady income for life. No matter what happens to interest rates or market conditions, your monthly pension never stops. Second, they offer protection against post-retirement financial risks. Once the regular salary stops, many people struggle with rising expenses, medical bills, and inflation. An annuity ensures you have a reliable income source to maintain your lifestyle and financial independence. That's why pension plans are a cornerstone of a secure and stress-free retirement. Type 7. Group Life Insurance. It provides life coverage to multiple individuals under a single master policy, typically offered by employers, professional groups, or financial institutions. It is a cost-effective benefit, often less expensive than individual life insurance plans, and usually does not require medical underwriting for members. Now let's understand group life insurance, a plan commonly provided by employers. Here's a simple example. Suppose a company pays the premium on behalf of all its employees. For a very low premium, often just 500 rupees to 1000 rupees per employee, each employee receives a life insurance cover of 5 to 10 lakhs rupees. Larger organizations may negotiate even better rates. For example, a company with 1000 employees might pay just 4 to 6 lakh rupees in total, and in return every employee gets 10 lakh rupees coverage under a single master policy. This makes group life insurance an extremely cost-effective way to provide financial protection to a large workforce. So, who should opt for group life insurance? Organizations, big or small. Institutions such as schools, colleges, cooperatives. Companies with many employees or members. Startups and SME looking for affordable employee benefits. Any entity with a group of people can offer this plan, and it instantly strengthens the benefit package they provide. Group life insurance comes with powerful advantages. First, it is extremely low cost. Because the risk is spread across many people, the premium for each member stays very low, while still providing meaningful protection. Second, it offers easy administration. There's just one master policy, one renewal date, and the insurer manages everything, from onboarding to claims. Third, it significantly boosts employee loyalty and satisfaction. When employees know their families are protected with a basic life cover of 5 to 10 lakh rupees, it builds trust and demonstrates that the employer cares about their long-term security. Overall, group life insurance is an affordable, practical, and highly valuable benefit for any organization. Indian life insurance market overview. India's life insurance industry has grown tremendously, especially after the liberalization of the sector in the year 2000. Today, LIC along with 23 private life insurance companies collectively serve more than 30 crore policyholders across the country. But here's the surprising part, India's life insurance penetration still stands at around 3%. This means that a large part of India's population is still underinsured or completely uninsured, giving the sector massive room for expansion. LIC continues to remain the dominant player, commanding the trust of millions with its strong legacy and large distribution network. However, private insurers have brought innovation and modernization into the industry, offering faster digital onboarding, customized products, and better customer experience. This healthy competition between LIC and private players has improved transparency, efficiency, and product choice for Indian customers. The industry has also seen a major shift in the way insurance is sold. Earlier, agents were the primary channel. But today, bancassurance, where banks sell insurance, has become one of the strongest distribution channels in the country. Along with this, digital platforms and online policies have grown rapidly, especially after 2020. Customers can now compare plans, buy policies, pay premiums, and even file claims directly through their smartphones. One of the biggest opportunities lies in rural and low-income segments. These regions form almost 70% of India's population, yet insurance awareness and penetration levels are still extremely low. Micro-insurance products, low-premium term plans, and simple digital onboarding can unlock tremendous growth in these markets. With the rise of smartphones, internet access, and government-supported financial inclusion initiatives, the rural market is poised to become the next growth engine for India's life insurance sector. Overall, India's life insurance industry stands at a powerful turning point, a strong foundation, rising digital adoption, and millions of potential customers yet to be covered. The future of life insurance in India is full of opportunity. How to increase life insurance awareness or penetration? To increase life insurance penetration in India, we need stronger awareness strategies. Different ways can be, first, digital education, Instagram, YouTube, Reels, vernacular content. Second, simplified product explanations. Third, more micro-insurance products. Fourth, training agents to advise, not sell. Fifth, government-led financial literacy campaigns. Sixth, employer-based group insurance. Seventh, young adults buying early. Life insurance is not a luxury, it is a responsibility. Start early, protect your family, and build a secure financial foundation. Your future is unpredictable, but your planning doesn't have to be. Secure today, protect tomorrow.